Hi, good morning, everyone. Pleasure to have you with us in today's webinar. We'll allow maybe just a few, maybe an additional minute or so just to allow everyone to come in. And as you're coming in, it would be great if you can also share in the chat just where you're joining from and the name of the organization as well, just for us to get to know the audience a little bit better. Thank you. We'll just give it another minute and then we can kick it off. Also, just on logistics note, if you find that there's any issues with any of the mics or the auditory, you're not hearing us well, please just let us know in the chat and we'll try to address it from our side as well. Okay, excellent. I think we can get started. And I see amazing representation already. So we have some people from Mogadishu, from Singapore, from Ethiopia. So that's a great way to start the day. Uh, um, we can kick it off. So without further ado, I'd like to introduce myself and today's webinar. So for today's topic, we're looking at bridging capital for scalable impact and really looking at the fantastic collaboration that is between Human Planet and Chemonics, which has been announced quite recently. My name is Omar Saif, and I'm the Vice President at the Global Climate Finance Center, which is based here in Abu Dhabi Global Markets, where I'm speaking from. And I'll be the moderator for today's session and really exploring the collaboration between Human Planet and Chemonics. Now, before we get into the topic itself, I thought it would be good to provide a little bit of context and to zoom out to look at some of the relevant macro trends that we're seeing here in the region. So climate capital and leadership we've seen has been moving eastward. And it's that the Gulf is no longer simply a source of funds, but it's also a place where decisions are being made and the platforms that are dispersing funds and dispersing investments are also coming out from this region. And the UAE currently sits in the center of that. It hosted COP28. It's also hosting the UN Water Conference later this year, and it has been a consistent leader when it comes to South-South relationships and also when it comes to climate finance and climate leadership. Now, what does this look like in practice when it comes to kind of the Gulf in leadership in this space? What we see is also via organizations like ourselves, the Global Climate Finance Centers, that the Gulf becomes a platform for deploying climate finance into emerging markets. The region holds deep pools of patient capital that includes the likes of sovereigns, institutional investors, and corporates. And when you combine that with the capital that's also existing in Europe and other places that coming from foundations and philanthropies, you have the raw materials for something that neither pool can build alone. And when you have blending between these two sources of capital, that's where impact is significantly amplified. And that's also our personal vision here at the Global Climate Finance Center, to have the region and the UAE to be a center for capital blending. And this brings us to, I think, the heart of today's conversation, because capital and ambition are the easy part. What's harder to find is the actual connective tissue that turns a commitment into a program that runs, delivers, and reports back. Moving capital takes two things that the market is still short of. One is the sophistication, knowing how to structure these blended vehicles, which is where Human Planet comes in, and delivery, partners who can get projects off the ground in frontier markets where most capital hesitates, which is where Chemonics comes in. The gap shows up constantly. Capital gets structured, capital gets committed, and the harder question arrives, who runs this once the money actually lands? So structuring and delivery together are what the eastward shift makes it real rather than rhetorical. And that gap is what we wanted to discuss today. So without any further ado, I would love to introduce Sabrin Rahman, who is the partner at Human Planet, who works on capital structuring and blended finance, getting capital into a shape that investors and DFIs are willing to deploy, as well as Melissa Gasmi, who is the principal at Chemonics Gulf, who works on what happens next. So designing and the delivery of the programs that capital is meant to fund. Now, just in terms of the structure of today's session, I would like to first of all allow both of our esteemed speakers 15 minutes or so just to go through the work that they are doing. We will also be opening it up for Q&A at the end. So please do use the feature that you have for questions in the chat, and we will bring them at the very end through kind of a moderated session at the end. So with that, Sabrin, I'd like to start with you. And given, I think, the background that you have and also the work you're doing at Human Planet, my question to you is, what does capital that's ready to deploy actually look like in the Gulf right now? So which pools of capital and the appetite and the constraints are relevant? Could you perhaps elaborate a little bit more on that?
Yeah, absolutely. Hi, Omar, and thank you so much, everyone, for joining us today. It's exciting to start unpacking this topic with real tangible examples, and I think the question you've asked, Omar, is very fair because, as you've said, the intent is real. So if we look at sovereign wealth funds, family offices, development finance institutions, as well as mission-driven corporates in this region, one that I had led for many, many years, we're seeing a clear alignment on purpose, whether it be net zero commitments, Vision 2030, social impact mandates. The appetite continues to develop, especially to support real outcomes. But I think what I've seen over my last 20 years in the region is that it's becoming increasingly harder to find a structure that turns intent into something that's investable. So it's not really about capital that's been committed, which we have no shortage of, but capital that's actually moving into a program or a structure that can absorb it, that can account for it, and actually can show that it worked. And that's why I'm so excited to work for Human Planet, because that's the exact gap that we try to fill. So we, in a nutshell, are a global impact finance advisory firm, but our focus is really on blended finance, facility design, program and fund structuring, as well as capital mobilization to support impact measurement. And what's unique about us is we don't just write a strategy and we don't stop at that. We build a structure that capital can move through. So in terms of what you were asking, in terms of what does the capital landscape of the Gulf look like, I see three main maybe buckets. So sovereign wealth capital, which has a longer time horizon, is patient, but it is starting to increasingly look for more social and climate co-benefits alongside financial returns. We've seen philanthropic capital continuously growing in this region, as we've seen in other regions as well, both from regional and international sources. And we know that that's concessional, and they are willing to take the first risk loss positions. And over time, we're also seeing a lot more private and institutional capital. So, really credible commercial capital coming in who require strong risk and governance management before a dollar will move. So, these are the three sort of main capital pools that I'm seeing in the region. And each one of them has a very different risk appetite. They have different reporting requirements, as well as time horizons. But I think the huge opportunity ahead of us is really bringing them all into a single structure. And that's the technical problem that we really want to solve for here, and see what we can do in order to scale it more effectively.
Amazing. Thank you. Thank you for that, Sabrin. I think that's quite useful, especially the breakdown of the various pools of capital. One question that I had as a follow-up is, where does the capital typically stall before it reaches a deliverable program? Maybe you can elaborate a little bit on that from your experience as well.
Sure. And I'll try to keep it really practical, right? So look, I think what we've seen is that most capital often stalls at the structure itself. So we see commitments, and in this region, we've seen pledges, MOUs, strategy papers. There is no shortage of that, right?
Hmm.
Um, but then the harder questions arrive once that's done. So, what is the exact instrument? Who holds the capital? Who is accountable for the outcomes? And what happens if a program underperforms? And I think none of the questions are really unanswerable, but each one needs a specialist to work through it. And that is often the part that's missing when a deal is first being assembled. So I think I've got two examples which might help bring this to life,
Hmm.
because I wanted to show what happens if we do take these questions into account before capital moves. So the first is a refugee livelihoods development bond, impact bond that we did for the Middle East. And it was really focused on supporting Syrian refugees and host communities across Jordan. It was roughly for $13.5 million. It was an instrument that ran over 4 years in partnership with the IKEA Foundation, Novo Nordisk Foundation, NORAD, DFC, and FIRD as outcome funders and investors. The program supported over 4,000 people in skills development as well as micro enterprise creation, of which half were refugees and 80% were women. And what made the structure quite special is that the returns were linked to the sustainability of the businesses after launch, not simply the creation, which is
Hmm.
often where we see that trade off. And what we felt is that really built in an incentive for ensuring that the outcomes were long lasting into the structure itself. And it gave further support to the entrepreneurs. And this matters for our region for a very specific reason, because we are at the meeting point for refugee flows, but also we've got substantial capital flows. So there is a huge opportunity for us to take that into a livelihoods and social stability discussion as well. And it also showed to us that an outcome linked investor grade instrument can actually be built and deployed in a
Hmm.
fragile context. So I think that's one example that really shows, how this kind of really starts coming to life. And the second one, very quickly, is another development impact bond that we did, and it had incredible return in terms of investor sort of the internal rate of return. So essentially, this was really to help structure a humanitarian impact bond across the DRC, Mali, and Nigeria with several investors, and it ran for 5 years. And these centers that were really focused on the operation and physical rehabilitation in post conflict areas saw an efficiency improvement of 80%. Over 3,600 people were served during the bond period. And over the course of the instrument and the lifetime of the centers, it's projected to support 40,000 people. But what
Hmm.
really made this quite special as well is the rate of return, as I said. That was 7% for investors, which is considered incredibly strong. And it actually showed that the impact created really equated to market expectations as well. So I'll just pause there, but I'm trying to show that you can have that dual edge, right, of
Hmm.
very solid financial returns, but tangible impact for the long term to be created.
I mean, there's a lot I would love to ask in terms of the actual capital structuring of that and how that came about, but maybe that's a conversation for another time. Immediately, what comes to mind here is for the two examples that you shared, Sabrin, is where does Human Planet fit in from an advisory point of view and also the structuring work that you've done? It'd be great if you can just elaborate exactly on what that role was, maybe using the two examples that you gave.
Of course. Look, I think what connects all of this, because the contexts again are so different, right? We've got post-conflict
Mm,
rehabilitation in DRC, refugee livelihoods in Jordan. I think that the connection is practice. Practice in terms of designing structures before capital moves, not after, and really deciding at the outset what the outcome is. Again, accountability, measurement, methodologies, and what the return will look like for each type of capital in the stack. And I think that's why it's such an exciting time here in the Gulf and the broader region, because that window and these discussions are happening now. We are seeing that awareness level really increasing. And regional capital is ready, sovereign and philanthropic capital is real. And international DFIs, what I've seen, are actively looking for credible local partners and co investors. So the region still needs more proven vehicles and structured instruments, but I feel that we are moving in the right way. And that's where we really can step in to build. And more importantly, and I think that's why our partnership with Chemonics is so special, because I've always believed that an instrument is only half the answer. And the other half is delivery. And that's what I hope, and I know Melissa will really unpack.
hmm to your point, we actually recently had an essay that we published in on with DevEx on the concept of trust capital and how it's an essential component and part of the overall climate finance piece. And uh, I'd love to hear your thoughts on the role of trust and the role of yeah, the role of trust when it comes to such organizations and such structuring that goes, just beyond the actual capital piece, but more in terms of the trust that needs to be built between investors and also implementers.
Yeah, no, absolutely. And look, my honest answer is that trust and structure are interchangeable and they feed into each other, right?
Hmm
But there is a specific sequence that's very important. And to me, structure comes first, and that's how trust is built. So we spoke a little earlier about deal stalling, right? And so when a deal stalls, for example, the first instinct is to say the investors and implementers don't trust each other. But I don't think that's true in most circumstances. In most of the transactions we've worked on, the trust is often a downstream outcome of a
hmm
structuring failure. So, for example, if the instrument doesn't clearly define who's accountable, the timeline, and under what measurement framework, then every conversation between an investor and an implementer is a negotiation, but in a vacuum. And in that vacuum, that's where suspicion can sometimes come in, where ideally it should be a structure in that vacuum, right? And just bringing the two examples again into the conversation. So the ICRC humanitarian impact bond was the reverse dynamic, where the funders were the ones who actually came in with a reasonable degree of skepticism because it was a post-conflict sort of context and it wasn't a standard infrastructure play. But when the outcome metrics were locked in before a single franc moved, both sides were looking at the same scorecard
hmm
throughout the whole 5 year journey. And so trust wasn't assumed, it was really built into the architecture. So I would always say, fix that structure first, and you'll often find that the trust problem either isn't there to even begin with, or it dissolves and becomes much smaller and easier to handle.
hmm That's excellent insight. And before we move on and bringing Melissa in on the implementation part, maybe one last question from my side, Sabrin, is in terms of how much capital you believe is stalled as a result of, not even reaching the implementation phase, whether it's due to trust or due to, like you were saying, maybe inadequate structuring, how much would you say is currently just stalled as a result of that?
Mm, that's a tough one, but I would say that more than what capital allocators or capital side actors want to admit, I think that the biggest variable is the strength of the implementation partner and the delivery partner. So, particularly in this region, I don't think we've got a capital constraint. As we've
Mm,
mentioned before, we're seeing all of these pools develop and become bigger over time. But I think the credibility of an implementation partner that the capital can point to and say that, look, this organization has the systems, the track record, the adaptive capacity to absorb what we deploy is very, very important. And I think that's why I said in my earlier response that the instrument is half the answer. So we
mm,
can, from our side as human capital, human planet, we can design a technically sound blended finance vehicle. We can have the correct risk tranching, clear outcome payments, governance, all of that stuff that investors love and recognize. But it can still sit on a shelf if there's no delivery partner that the outcome funders really trust to run that program. And I think, when what we saw with the livelihoods bond in Jordan was an excellent example. The structuring work was necessary, but the reason why investors were comfortable with deploying $13.5 million into a refugee context was the credibility of the implementing partners on the ground. So I've always seen capital follows where there's confidence in delivery. And that's why we're so proud and excited to really talk about our partnership with Chemonics, because we think we're closing that gap.
mhm. No, that's fantastic, Sabrin. And Melissa, I'd love to bring you in now because we've talked a fair bit about the actual structuring bit, but in this soon to be not hypothetical scenario of you both working together, the capital has been structured, it's been delivered, it now sits with you. What's next? How does that get implemented?
Thank you so much. And first, I just would like to thank you for moderating today and for the collaboration with GCFC and your very important central and strategic role in this space. And it's really, I'm really excited to be here with Sabrin today and appreciate everyone joining us. So thank you. And clearly, I really appreciate the turnout, and it really shows that there's great interest in the vast potential of this partnership. So I really appreciate those who've joined us today. So I thought I would pick up where Sabrin left off at the point where capital has been structured and committed and now needs to become a program that runs and adapts and delivers results. And that's truly where Chemonics comes in. And this has been our work for the past 50 years in more than 80 countries. We've designed and we've delivered very complex development programs, included blended finance structures across climate, health, and economic resilience. And through that direct execution, we've developed expertise in systems integration and program management and scaling implementation across multiple geographies and in fragile contexts like the ones that Sabrin has talked about. So let me give you a sense of what that looks like in practice, because when we say delivery, it's one of those words that sounds very operational until you see what it entails and when you see the rubber hit the road, to say. So one example I can share is the Green Guarantee Company. This is a UK-based privately run guarantee company that was built specifically to de-risk green bonds and loans across Africa, Asia, and Latin America and it did that by providing investors with investment-grade guarantees, offering protection against potential losses and non-payment. So we as Chemonics played a role in catalyzing climate finance here, but our role was less the financial engineering and more serving as a convener and as the manager of the project. So we partnered with Pollination and some other firms in the climate advisory space to run the due diligence, to lead the investor outreach, and establish a special purpose vehicle that pooled the capital for the GGC. And we covered that vehicle's management fees with support from a donor-funded program for the first 3 years. And we also facilitated a grant that sits inside it as first loss capital the piece that really served to help attract other investors behind it. So getting the finance structure is getting it right is very important, and it's one part of this. And covering what it actually costs to keep it running year after year is really what will make it work in the long term. So Chemonics brings the expertise and the is there a echo or we have? Sorry, I thought. Chemonics brings the expertise and the experience of putting together the institutional machinery that keeps something like this running. Standing up the governance structure, staff team, getting the right people in place and operating it day to day, coordinating with the technical assistance providers and the counterparts on a shared work plan, and just managing the reporting and the compliance cycle that funders and investors expect for the life of the instrument. And this is the literal day-to-day of it that we manage. The people, the work plans, the results frameworks, the monitoring and evaluation systems, and the management to keep a multi-year program on track. We've built this same kind of infrastructure at other altitudes as well. So we also stood up the Climate Gender Equity Fund as its own facility, running the competitive process that brought in 2X Global as the specialist grants manager, building the governance and reporting structure that satisfies both donors and corporate funders like Amazon, the Visa Foundation, Reckitt, and the UPS Foundation, and managing the fund through multiple grant rounds since. So the first cohort alone put capital in 3 women-led organizations across Nigeria, South Africa, and Kenya, which is really proof that the structure can move money, not just the intent.
Mm-hmm. If I can just interject here, Melissa, I think both examples you've given are really fantastic. So one with a guarantee company and the second being a fund. Now, how about when you're dealing directly with a government, especially in an emerging market, and there's no financial vehicle in between? How does the dynamics of that change? Is it easier, more difficult? Would love to hear your thoughts on this.
Right. No, it's a really good question and a very practical one. And an example I can provide is an initiative and a project we worked on in South Africa. So in this case, a bilateral investor brought us in to set up and implement a program to help turn the national government's low carbon transition strategy into something operational. And so we came in and we built a 5-firm consortium to do it. So what we learned was the strategy only became real once we engaged at the municipal level, where individual projects get planned and built, and municipalities, what we learned, they lack the project planning and the policies and the coordination with the national government to really align practically with the national government's vision. So we made an intentional choice to work directly inside the municipalities themselves rather than to advise from the national level at a distance. So this is what practical implementation looks like. So that really meant engaging with more than 20 municipalities across 8 provinces through a structured process. So we worked with each municipality, each one formally requested support. We engaged with them on an individual level. We worked through their specific barriers and what their needs were on the community and municipal level. And we built and phased an actual project pipeline. So we worked with them, collaborated with them to select what to support, to match the technical expertise to what the municipality needed. And we stayed with them throughout the procurement process. And we tracked all of it through a dedicated monitoring and evaluation system. And we fed the lessons that we learned out. We sent it out. We followed those and sent those back through case studies that other municipalities could use. And I think an important point to emphasize here is also just serving as a convener. so that these municipalities we could convene them, they could learn from each other, and I think develop relationships with each other as well, which help to sustain their efforts, which is what we also want, is sustainable outcomes. So the result was over $200 million mobilized on 31 investment ready projects. And I think it really highlights our capacity to, what it looks like on that municipal level and aligning local implementation to a national vision and making that a reality. So what really ties it all together is discipline. Someone must really own what I would call the unglamorous middle, managing the people, the work plans, the results frameworks, and really the reporting cycles that makes execution possible and that delivers results that can be measured. And that's the role we play. And it's what I would say the role Human Planet and Chemonics are building together for the Gulf, and not as separate halves of a deal, but truly as partners who each solve a different half of the problem.
Yeah, I absolutely love the unglamorous middle. I think it's so incredibly true, and I think maybe even for some of the audience that's with us, it will resonate, especially in this region in the Gulf, where there's no shortage of strategy consultants and strategies, but when it comes to the actual implementation, as you said, it's oftentimes unglamorous, but incredibly necessary. Melissa, I'd like to bring it back to a little bit on the Gulf region itself, and also one of the points that Sabrin was making earlier around the role of structuring, and then also the importance of having strong implementation and delivery partners. What I'd like to ask you is, at the moment, for the Gulf to become the deployment platform that, we've described and that we envision, what has to change or what has to become true on the delivery side? What would make a sovereign like Mubadala, for example, or Adia, or some of the others that we have here in the region, confident that any kind of capital that they're committing will become projects on the ground?
It's a very important question, and my answer would be pretty simple, and that would be to build the delivery partner into the structure from day one. So for the Gulf specifically, I would say there's even a sharper test, and that's speed and proximity. A sovereign or foundation committing capital here wants the delivery partner already structured, ready to go, and ready to mobilize the moment the capital closes. So not assembled through search months later, and ideally already present in the region, rather than flying in case by case. So I would say that what would give a sovereign or foundation confidence is really a track record. And it's not something that's improvised for this partnership. It's really what we've built our institutional identity around, managing exactly this type of handoff between committed capital and what actually gets built across dozens of countries and at every scale, from global financial instruments, down to even a single municipality. So, this type of operating history, it really takes years to build, and it can't be assembled overnight. So I think that that entities here could take faith in knowing that there's a track record here, and kind of two halves of the whole that can work together to structure and also implement and deliver.
Brilliant. Thank you. Thank you for that. And if I can ask now, just looking a little bit forward, is when it comes to the Chemonics Human Planet partnership, is this something that'll apply broadly across the region, or is it in a more narrow focus? Is it more narrowly focused for now? What's the geographic and thematic scope of the collaboration itself?
So another really good question. I would share, I'm sure Sabrin would agree with me, that the UAE is where our relationship started, and it's where the partnership is anchored. But the model itself is not UAE specific. It's broad by design. And it's the same structure, capital and delivery, designed from day one. And it travels anywhere in the Gulf where there's capital looking for a real path to achieve impact. So what's anchored here in the UAE is the relationship, and the vision that drives us, not the geography per se. every Gulf market has its own regulatory environment and its own institutions. So the specifics of how this gets applied will look a little different from one place to the next, but the underlying model won't change. So as the conversations open up elsewhere in the region, this is the model that we'll bring with us and we'll tailor to each unique context.
Amazing. Thank you, Melissa. And I would like to move to maybe the audience in a little bit to have some questions. We've seen already a few in the chat and the Q&A box. Before that, I'd like to ask a question to the both of you. And I also see this reflected a little bit in the comments in the chat, is more around what are some of the structural gaps that need to be fixed in Gulf Capital in terms of how it can have greater impact. So maybe to the both of you, if you'd be able to share your thoughts on what are some of the structural gaps that should be addressed if we want to have significantly more impact from the capital that's coming out of the Gulf. Sabrin, maybe I'll start with you and then I'll hand over to Melissa.
Yes, of course. Sorry, I was trying to go off mute. Look, I think I know you and I discussed this, Omar, last night, kind of going back and forth, but I honestly feel that we have an opportunity now to build a regional outcomes infrastructure and vocabulary and framework for ourselves, right? So to date, we have been looking at using DFI templates from international frameworks. We've been looking at what other markets are doing on ESG and so forth. But it's not that it's wrong. It does get things done and it allows us to have consistency with other markets. But we have this amazing opportunity as awareness and traction grows to really start building things that have a vision and a track record that really talks to this region. So what does good look like in a refugee livelihood context, or in early childhood development, in climate adaptation? I would love for us to develop things for this region, by this region. And I think that also helps with investors coming to the table because it's something that capital allocators can also relate to. And also be able to align perhaps their priorities and standards inside instruments when we are speaking a similar language. But I think, yeah, we just have this, I think a gap or an area of improvement, let's say, is really the opportunity to integrate regional ownership of what success means.
Thank you, Sabrin. Melissa, some thoughts on this?
Yeah, I agree with Sabrin, and I would say the gap isn't capital and it isn't ambition. I think as we've said earlier, it's both are already here. What's missing, I would say, is also just a delivery partner that can integrate the regional ownership that we've been discussing into delivery as the capital is structured and as it closes, rather than chosen afterwards, so that delivery, how the work is run and the outcomes achieved reflect the intentions of the investors. So retrofitting delivery capacity into a deal after it closes is far harder than building it in from the start. So the fix is straightforward in principle, treating delivery as a design input alongside the financial structure and not as a decision that is made later. And that is, I think, truly the partner, the model that Chemonics and Human Planet are building around, and it's exactly why we're having this conversation.
100%. And I think to validate both of your answers, even our own experience at GCFC and our observations have been that one of the biggest opportunities, and it also reflects the existing gap here in the Gulf, is that when it comes to capital deployment, whether it's on the humanitarian front or whether it's purely from a commercial investment lens, they're often incredibly siloed. So we haven't seen a lot of, how can we overlay some of the you can say shared objectives between that capital that's being deployed. And I think that gets to the heart of blended financing and how can we leverage both pools of capital in a way where, there is a return and at the same time there is a social impact, similar to both examples that you provided. I wholeheartedly agree with both of your answers. And I actually want to bring in one of the questions that we had from the chat. So we had Osman Kermani. He asked a question about what the single biggest reason a well-structured deal still fails to reach delivery in this region. Um, I would love to, and I don't mean to put you on the spot, Melissa, but I think when you were mentioning the role of working with governments in particular in other parts of the world, sometimes the capital is already structured, it's allocated, but the delivery part of it and how and the absorptive capacity of some of those governments and institutions to be able to take on that money and have it deployed into projects. Is that something that you've seen as a challenge? And maybe you could shed some light on that, given Osman's question.
I'm happy to. And Sabrina, I'm not sure if you had some thoughts on that as well, but I wanted to let you go first if you response.
Yeah, absolutely. Look, I think from my perspective, um, sometimes it really is contextual gaps. So, we design a lot of things for with an investor lens in mind, but we don't always think about how does it land, right? So what I mean by contextual gaps is that sometimes these things come to play only when an instrument tries to move from signing and structuring into operational. But the key is if we can identify them early enough, that there might be these issues when it comes to implementation, and that's often what really slows things down. It could be a fantastic design. The architecture makes this, all the sense in the world, but we've
Mm-hmm.
just not integrated that risk of delivery. And so the handoff between capital and delivery is, in my opinion, where we lose a lot of the traction in deals in this region. And that's exactly what we're trying to fill, right? How do we ensure that gap doesn't even exist from the outset, because we've co-designed, co-structured to identify from the onset what the risks in delivery could be. Melissa,
Mm-hmm.
please feel free to add.
Fine. Yeah, well, sure. Add on, and it might be taking it in a little bit of a different direction. And I saw one of the questions here about when things in delivery don't go exactly as planned.
Mm-hmm.
And I mean, I think that that's what delivery is all about. So, a lot I would say, there's a lot of room for adaptation, right? Like things can change from initial design and, you know, officials can be replaced, you can lose government contacts, a community that you're working with could push back on something that you didn't expect. The economy can shift, and the budget that made sense a year ago no longer does. And I mean, I think that these are just really nitty gritty examples of what happens when we put a plan into action, and you need to adapt. And I would say that the answer that I would share is that we build in adaptive management from the start. So we start with the theory of change, specific enough to tell when an assumption has broken, and not just when the work has gotten harder. And it also means putting the right people into management roles and into implementation that are making decisions close enough to see the results and to detect or spot something that is changing or occurring differently than what was intended, and with the authority to act on it on that practical delivery level. And it means also having a results framework and a monitoring and evaluation plan that surfaces issues or changes in real time, with clear thresholds for what's worth acting on, so that the team isn't debating it, in the moment, rather than, whether something is a real problem or if it's just noise. So I do think that things happen, between design and implementation, and it's about keeping your eye on what the investors' outcomes are, but also kind of working with the community and the stakeholders on the ground to achieve sustainable results.
I'd like to build on that a little bit. There was one question that was received earlier as well. Sorry, there was one comment that you mentioned, Sabrin. I think it was one of the examples on outcome-based financing, right? And the question that also comes up is how important is reporting in all of this from the projects that are delivered that go back to the actual investors themselves in building that positive momentum and demonstrating the impact that's via through these projects or through these vehicles. Either of you, if you'd like to answer that one.
Yeah. I mean, I can start. Look, I think it's incredibly important because that is, look, we talked about trust, right? Reporting in many ways is your trust building methodology. The more transparency you have, the more real-time data and without a lag, and that you are actually measuring the outcomes rather than just the outputs, I think is very, very important. And that's where within the structuring phase, all of that needs to be captured. What does success look like for all parties? That's agreed. Therefore, then the reporting is much easier from the ground up for us to take back to investors. So I think that level of definition, that level of alignment at the onset is critical. But then again, reporting is just as important. But we have to speak the same language, and I can't stress that enough.
Excellent. I'm going to take one more question from the audience, and I think we will probably have to wrap up the session afterwards. We had a really interesting question on blended financing in general and in the role in the context of Gulf capital mobilization. So in a lot of blended finance, typically you would require first loss, some kind of a first loss tranche or position that would help unlock all the other tranches. In the Gulf context, who do you see playing that role? Are there institutions and organizations within the Gulf that can do that, or is that something that would need to come from abroad? I'm paraphrasing. That's not exactly how the question was put, but
Yeah,
Sabrin or Melissa, if either of you want to take that on.
no worries. Melissa, do you want to answer that or shall I?
I will let you start.
Sure, no problem. Look, I would love to see more and more of this come from the philanthropic space in the GCC. And I think, again, having worked in this space for a long time, but on the other side of the table, right, where I was a funder, I think there is a real opportunity for the philanthropic community to step in and to really change their deployment models. And we are seeing that. So the discussion on venture philanthropy is becoming a lot more sophisticated. A lot of the large foundations are starting to think very, very laterally, to move from grant disbursement into how can structures that they support really have a longer term tenure. And what's most encouraging is that these conversations are being had side by side with commercial investors in the room. So, Omar, you mentioned we were all in silos, and you and I have been in the region for a long time. We know how those silos operate. But those silos are being broken down. We're starting to speak the same language because we know that the issues that we're facing, not just in this region, but globally, need collaboration of capital. So I think the time is now. We have enough foundations, we have enough philanthropic ventures, both state backed and through family offices. That my call to action is come and speak to us. Let's see where your capital can really 10x because we can bring in
Yeah.
other pools of capital to make that go further and faster.
And maybe I can also provide a practical example that shows the maturity of some of the organizations in the region. A lot of the concessional financing that did come out from places like the UAE, typically it was done as government to government, soft loans and things of that sort. In light of the UN Water Conference, which the UAE is co-hosting along with Senegal, we had an announcement in January, I believe, by the Abu Dhabi Fund for Development, which is a very large concessional financing provider, and they announced a $2 billion global water platform, and 1 billion is their own concessional financing, but the other billion was meant to be crowded in. So it's already reflecting the thought process of how some of these organizations, it's no longer just about managing their own concessional financing, but they're already thinking about how do we bring in private capital and other sources, other pools of capital, so we can amplify that original billion that they had in mind. So I completely agree, Sabrin, that they are beginning to break down. I think there's still some work that needs to be done, but everyone is starting to think and work in the right direction. So with that, I think we're almost at time. So I'd love to just provide maybe a very brief summary of the session and maybe next steps. What I heard, I think loud and clear, is that when it comes to climate finance, it's not only about structuring, but it's also about having capable delivery partners, which is very much around the heart of today's session, bringing an advisory, a strong advisory partner like Human Planet, and then a very capable implementation partner like Chemonics as well. These two are really important. From a Gulf point of view, there's increasing sophistication and interest by various organizations, whether they're in philanthropy and whether they're sovereigns and so forth, to have more capital deployed into emerging markets towards climate-related projects, be that in infrastructure, development, or otherwise. And the pathways to do that will require increasingly more and more blending and breaking down of silos, something that we already see signs of, but that there's also additional work that needs to be done in that space. So I'll pause there. I think that's a great place to stop today's session. I believe you have everyone in the chat. Thanks again for engaging with us, and I believe you have the details of both GCFC, Chemonics, and also Human Planet. So if there's any follow-ups or you'd like to get involved in any way, please do reach out to the organizers, and I'm sure we'd all be happy to speak bilaterally and offline.
And Omar, thank you so much for taking the time to curate this discussion. I know that you've been quite busy, so we really appreciate your time and efforts.
My pleasure, and it's truly wonderful to go into practical case studies and to hear more about both of your experiences. So thank you both.
Thank you.
Thank you.
Thanks everyone for joining us.
Thank you, everyone. Bye-bye.
Bye.
Bye.